not in line. It's way above expectation at 4.8. Now, why is that 4.8 bad? Because not just that the market, after upping its expectations, was looking at 4.6% inflation for June. Remember that the May inflation is 4.25%. So, we were receding for the past 5 months, Jan onwards, lower and lower. But finally, the high has come higher than what people expected. What has happened on predictable lines is the food inflation. That one is up 4.5%. Our poll had expected a food inflation of about 4%. So 4.49, as you can see, food inflation is a huge jump over the May number of 2.91. If I read out some of the month-on-month numbers, it will ring true with your experience. Vegetables up 12% month-on-month. It is flat year-on-year, but 12% month-on-month is quite a jump. Cereals is not so bad. It's only 0.5% up month-on-month. So that's a bit tolerable because it's a weighty amount. The weight it brings to the CPI is huge. But a surprise number is meat and eggs. Meat is up 3.8% month-on-month. I wouldn't know about that, of course. And eggs are up 5.5% month-on-month. Both those are coming as shockers. So it's not just a vegetable inflation. It's quite possible that a vegetable inflation becomes an eggs and meat inflation because people substitute foods. And that could be one reason why you're seeing this kind of overall food inflation. Not a good sign at all. Core inflation, I think, has come only at 5.1. That's a calculated number, I think 5.12. People were giving me a number of 5.2 when I was polling them. So this may be a bit of a relief, but food, we need to bring that under control. Coming back to the IIP number, a good number actually at 5.2%. The best numbers we got for 4.8, 4.9. 5.2 is a good number. So it's good growth, and because there's growth, there's more demand and there's inflation. It's a growth story, but we have to worry about inflation. Let me get to the experts. Very patiently waiting by is Rupa, Rege, Nitsure, the Chief Economist at L&T Financial Services, and Nikhil Gupta, the Chief Economist at Motilal Oswal Financial Services. Both of you, thank you very much for your patience. We were delayed by TCS. But Rupa, is this number alarming, 4.8?
Yes, because against the backdrop of, shadow of El Nino and unevenness in the distribution of monsoon, already, we have started seeing not just the vegetable prices, but also the cereal prices increasing on a sustained basis. Of course, government has put bans on exports and imposed stocking limits, etc. So they are trying to counter it. But I think the future trajectory of inflation will be influenced or will be shaped by the food price dynamics. So at this stage, we are facing a lot of uncertainty because of food inflation.
Okay, let me try and play devil's advocate, as in, play for the doves. Nikhil, the important point is core inflation has not gone up much. From the numbers, that quick calculation is giving a number of 5.1. Okay, that's also the Informist number. That is the same. I think it was 5.02 last month in May. That should be a bit of a consolation, isn't it? We hear that Chinese imports prices are falling, especially chemicals we heard, were rampant. So do you think that food, as always, is temporary and therefore this will be perhaps a 2-3 month issue?
Hi, Latha. Yes. So broadly, yes, it was slightly higher than where we were expecting it and the market consensus. And I broadly tend to agree that we do not see core CPI moving beyond 5.25 or 5.2, which has been depending on how you calculate core CPI. But we do not see core CPI increasing even to 5.5%, let's say 3 or 6 months down the line. We see it very stable at 5%. So I do not see it as a concern because it was close to 6% 6 months back, or even 4 or 5 months back. And last year it was about 6%. Whatever increase in inflation that we will see in the coming months, which is very likely we could see 5% plus inflation in July and August, but it would be played by the food inflation, and we know vegetable inflation would definitely play a more important role in pushing inflation higher. As far as the durable inflation or the demand-led inflation, that is core CPI, is concerned, I don't see core CPI inflation increasing in coming months.
Okay. So are you all revising your year-end numbers at all, or any of the intermediate numbers, Nikhil?
So yes, for July, August, we were earlier close below 5%. Now we are looking at close to 5.2, 5.3% because tomatoes itself is going to add 70 to 80 bps to inflation.
Okay.
Then there is potato as well, which is going up, and a few other vegetables. But then on the other hand, we have, as you mentioned, chemicals, which is not directly a part of CPI, but we have oil and fats, which is definitely coming off 18-20% on YOY basis, be it sunflower oil, vanaspati oil, all the components within oil, and some other items. So I'm still not seeing 5.5% inflation reading next quarter or next to next quarter. And we need to understand that even with slightly higher inflation in June, the quarterly inflation is 4.6%, exactly in line with the RBI. And the RBI already believes, in fact, the market consensus is 5.2% for next quarter, which I believe is likely, I mean, according to us, we believe it could be lower, but at worst, we believe we are not going to cross 5.2%.
Okay. Okay, that will be a consolation. Rupa, what's your estimate? Are you changing year-end estimates at all? RBI is sitting at 5.1, right?
Yes, but there is every probability, I would like to take that call by the end of August when we will have fairly good assessment of, the monsoon distribution, both spatial as well as temporal. But having said that, let me tell you, core inflation, if you take X food and beverages and X fuel, then it is actually 5.19. And if you adjust it for tobacco, pan, etc., that category, then it is 5.15. So it's not very close to 5%. It is also inching up. Okay. And the way economic revival is happening, we are seeing a very good growth traction in contact intensive services, housing, rentals, etc. So even though core has come down from 6%, I don't see that it will ease very rapidly going ahead.
Okay, but anyway, what stood out for me was their housing index is down 0.7% month on month. I don't know whether there's some calculation over here or some reset that happens, but that's a bit surprising. I mean, one has heard of slower growth in home prices or rents. One hasn't heard of a come down. I mean, down 0.7% on the month. 0.7 is not even a laughable number. It's almost 1%. Looks very surprising. So that could be something that could get corrected going forward. We don't know. But Nikhil, I want to come to the growth story. At 5.2, it's not just that. The components, consumer durables is only 1.1. We know auto sales weren't so good in June. But, okay, we're talking about May. Consumer non-durables up 7.6%. Infrastructure goods 14%. Of course, it's government driven. Capital goods up 8.2. Overall manufacturing is 5.7. That's 80% of 77% of the IIP. Growth is strong, wouldn't you say?
Would agree, Latha. Again, growth has been better than what we were expecting. Till May now we have all the data, and it definitely does not seem like there has been a serious slowdown in growth as of now. So yes, it has been better than anticipated. The consensus, I think, for IIP was 5%. It is slightly better at 5.2%. So yes, I tend to agree with you. I think it's a cement production or infrastructure, as you rightly pointed out, driven by the government sector. They have done really well. Cement production, I think, was 14-15%, or construction sector, as we call it now. Okay. So yes, this investment-led growth has been very
is working out. Something else is working out. I'm just getting the US CPI numbers, and let me read out to you. The poll had thrown out 3.1. It's come at 3%. Month on month was expected to be 0.3%. It's come at 0.2%. Rupa, Nikhil, if you all can stay with me for about 2 minutes, let's just listen in to what CNBC US is saying on the inflation number, and I want your reactions.
Do all that because I think that over a year, over the next 12 months, we're going to get it down very close to the Fed's target, maybe 2.5%. But I don't think it's going to get there in the next several plus months. And that's the rub. So when you ask me where Fed fund futures need to be, if they're taking the tack that they need to control it immediately and see the drop immediately, they're going to have to go 2 or 3 more, in my opinion, higher than they currently are. So another 75 basis points. Maybe they do 25, maybe they do 50. But the point is, it's coming down, as I referenced, by going over all those months. And I continue to think we're not going to only see the same type of progress, albeit more slowly on the year over year, but we're going to see it continue, and it's all going to occur higher for longer. I think Raphael Bostic has expressed some of those exact sentiments. I just don't think that the central bank believes that we're smart enough to understand that if they take that tack, they're not being aggressive enough in the here and now, and I think that's the issue.
Right. Right. All good points, Rick. Thanks. Stay with us. Let's bring in a few more voices to talk about this new data. Alison Schrager is a senior fellow at the Manhattan Institute. Betsy Stevenson is an economics professor at the University of Michigan and a former member of the President's
Okay, I think the core inflation in the US also has come in lower than expected. I couldn't get that number very easily, but I think that's also up only 0.2% month on month. So core inflation also not that big a worry, maybe lower than estimates. So on that note, Rupa, should we worry so much? It looks like we are not going to see runaway rate hikes from the US going by the current CPI number. Probably July is a given because, that's reacting to the jobs data, etc. Do you think the Reserve Bank has to worry, or will it just continue this pace of, long pause?
I think they will continue for the phase of long pause because they are certainly more driven by our own growth inflation dynamics. And luckily at this stage, all macro financial stabilization factors are good for India. So even if US Fed rate goes up, the interest rate differential gets widened, I don't think that will pose any threat for FPI inflows into India because India's, in relative terms, macro financial stability indicators at this stage are very robust, and that will not be a concern for Reserve Bank of India. But one thing is there that US Fed, they will try to achieve their target of 2%, and so taking cue from today's data also is not correct. We have to see whether secularly their inflation keeps coming down. But yes, definitely easing of US inflation is positive, not just for India, but for the entire global economy.
Yeah, and for more immediate purpose, the dollar index is now moving towards the 101.3 mark, a fairly steep fall, which also will give perhaps less concern to the Reserve Bank in terms of the rupee. So, I mean, all macros playing out to our advantage at this point in time, at least to macro stability. Nikhil, just finally your point, your thoughts. US inflation also lower than expected. So even if our inflation has come in higher than expected, do you think bond yields need to react, need to go higher?
I don't think so, Latha. I mean, there could be some immediate reaction, but I don't think it would be significant enough. And yes, US inflation is lower than anticipated, but I think the Fed is playing a long game here. They are not just interested in what happens to inflation over the next 3 to 4 months, which is where the base effect will play out, but they are more concerned about whether this fall in inflation is going to sustain or not, whether they are going to see 2%, even if 3-4 months down the line they see 2%, will it sustain 6 months, 12 months down the line? And this is where their line of defense that there could be another 2 more rate hikes, as they told us last month, could play out.
Okay.
For the RBI, I don't think we are going to hike interest rates at all. Of course, if the
there was
Fed is
actually
hiking
only
it,
a fear that if the Fed rates tend to be even more than 2, or if for some reason, the data is hawkish, RBI can play a stealth hawkishness. That is, keep the money market, interbank market in deficit. Keep the interbank call money rate a little above 6.5. Those fears were there, but you think now they get wiped out with US inflation kind of becoming a little benign?
I don't think anything gets wiped out.
Okay.
These fears will remain there, and we have seen that RBI has tolerated the call money market rate at the upper range of the corridor that we maintain. So that could be a possible scenario, but I don't see any official rate hike.
Okay, fine. Just a word from you, Rupa, on growth. The number is 5.2. I think that is better than the poll that we got, which was a little shy of 5%. But the individual components, manufacturing at 5.7, Capital goods, infrastructure, all of them, like some of them in double digits, especially infrastructure at 14%, capital goods 8.2, extremely impressive numbers. You think growth is on a sounder wicket than one thought?
Definitely. And in the month of May, most of the high frequency indicators also, were moving in that direction. Even the degrowth of exports as well as non-oil, non-precious metals imports, etc., it was on the lower side in the month of May. What is pleasant is the fact that consumer durables growth has come back to positive growth zone, because out of past 19 months, for more than 14 months, it was in a negative growth zone. Of course, it's lowly positive, 1.1%, but still, that's a good reversal of direction. What makes me happy is 7.68% growth in consumer non-durables, because that's a good proxy for rural demand. And, thanks to last year's rich Rabi harvest and very firmer MSPs and higher mandi prices than MSPs for most of the Rabi crops, etc., farmers' cash flows till date have been good, and that is getting reflected in demand. But having said that, most of the high frequency indicators again had shown some deterioration in the month of June. So I don't know whether this picture of May will sustain at the same level going ahead. But one should be hopeful, because the government's capex push is getting reflected in good growth of capital goods, infrastructure goods, construction, etc. And that has a multiplier acceleratory impact. So let us see. But there is every hope to stay cautiously optimistic.
Yeah, absolutely. We just want the private capex cycle to start off. At the moment, we see private capex more participating when the government puts out an order and not on its own. But 5.2 is a very good number, and I think we should correct that headline. It's industrial output in May growing at 5.2 versus an expectation of 4.9. So it's a very good number. It's not April. There's a mistake in that ticker. It should say May. Meanwhile, Lakshmi Iyer has joined us. Lakshmi, what will your markets do tomorrow? Will they sulk over the over the higher than expected inflation number, 4.8? Or will they be happy that the US inflation number is 3 and not 3.1?
See, Latha, we can't be in a situation of Begani Shadi mein Abdullah Diwana. So we have to be more realistic to the inflation numbers in India. And also, given the fact that, the tomato, onion and potato prices, specifically the tomato prices, are still reasonably sticky. And this has contributed to the inflation numbers. And some bit of the spill through is likely to happen into July as well, which means that the July, August, September number could be well above that 5 quarter mark. So I think these are some of the things which the markets cannot completely be oblivious to. So I think, there can be some small antidote, but I think the yields are still a little bit on a sticky innings. And given that inflation, nor the supply side is supporting right now, we could see some inch up in yields in the near term for sure.
Okay. So the bond market is Abdullah, and it should not be looking at the US markets. Got it. What's your second quarter number, Nikhil, for inflation right now? Would you push it up 5 quarter?
Yeah, so we are close to 5.1% now. Earlier, we were close to 4.9 or so.
Okay. And what about you, Rupa? Would you expect close 5.1, 5.2 for the next 3 months, July, August, September?
Between 5.2 to 5.3 in my assessment.
So Lakshmi's guess of 5 quarter is spot on. That's where the market is. Lakshmi, so tomorrow itself, do you think we go towards 7.15? We are at 7.11, I think, when we closed the 10-year. And what is the slightly longer term range?
So I'd say that we already tested 7.16 levels just a few days back, and then with US yields coming below 4%, we saw some bit of a cool off. I think we could revisit those levels and probably head towards the 7.20-25 mark over the next few weeks or so. Not necessarily immediately tomorrow. Also, we need to track, Latha, that crude oil prices are behaving a little bit as an irritant. So that's another watch point from a bond market standpoint. So I think these two things near term could mean some dampener on the bond yield front.
Okay. Ladies and Nikhil, thank you very much indeed for giving more color to the macroeconomic data that's just hit us. Thank you very much for staying over. We were delayed by the TCS numbers. Just to wrap it up for those who have just joined, the inflation number has come in higher than expected, actually a good 20 basis point higher than our poll of 4.6, coming in at 4.8. And it's a good 60 points higher or 55 basis points higher than what came in May. For quarter has jumped to 4.8, largely a food inflation at 4.5 compared to expectations of 4% and compared to just 2.9 in the month of May. So it is a food-driven inflation that we see. Core inflation, not a bad number at all. It's just, a little south of what the market was prepared for. So perhaps this inflation spurt is temporary, largely driven by food. The expectation is that we are going to see the after effects in July, August, September as well. So no softness expected from the Reserve Bank. But the positive part of the picture is provided by growth. The May industrial output number coming in at 5.2 against expectations of 4.9. Good growth usually spells inflation, and that's exactly what we are seeing now. So don't expect the regulator to soften rates anytime now, to even soften liquidity anytime now, but the economy in fine fettle. That's the message from the macroeconomic data. We wind up on this special presentation. Do stay tuned in. After a break, we are going to get you more on the HCL numbers. You heard TCS. It's time you heard about the HCL numbers as well. Back in a jiffy.